And I'm back, because I couldn't get enough of this stage time on my agenda today. So I'm here with Mike Bowden-Distel, Jeremiah Reed, to talk about a couple of new data points for SONAR. SONAR at its core is about data. It's about fast data, it's about new data, reliable data. And we've added two new data points today that I think the market is ripe for. I know personally, coming from the LTL space, myself, from my background, a lot of people have been asking about LTL data. We've talked about it in Peace State of Freight yesterday. Somebody reached out and said, tell me why rates are not moving the way that the truckload environment is for LTL. That's a complicated question to answer. But the bottom line is that it's just a different environment in general. There's less fragmentation in the LTL space. So two data points we're going to talk about today. Mike's going to come here after I talk about this LTL data that you're looking at right here to talk about intermodal contract rates. Again, the intermodal space probably as robust as it's ever been. And it's been more important to monitor the intermodal sector over the last year than it's since COVID, thanks to a lot of the import demand driving up that volume coming off the Southern California coast there. What you're looking at right here, as Jeremiah has pulled up so graciously as I talk, is the average median rate per ton mile for mid-haul Class 70 freight. Now, you're going to say, what did you just say? Anybody that is in the LTL market is going to have a general understanding of what I'm talking about, but there's a lot of nuance here, especially when you're talking about LTL pricing. LTL pricing is calculus to the truckload environment's basic math, as I've always said. The median rate per ton mile. Why is this important, and why should people be interested in it that ship LTL or that just deal with the LTL market? This is going to be a pricing directional indicator. So looking at over the last 5 years, we've got prices going up during COVID, or actually towards the back half of COVID. In late 2021, LTL prices took the most substantial increases. The LTL market is very contract heavy. It's very contract based. So when you're looking at LTL pricing, it's going to lag the truckload spot market by a good clip in general, because those rates are generally processed on a 12-month annualized basis, if not longer. And then most of it is contract. There's a very small amount that you would consider a spot LTL movement. And even the spot market for LTL isn't necessarily that spot. There's always a blanket pricing involved in that. So the index you're looking at here helps us weed out the noise that's in the LTL pricing mechanism. There's three things that move LTL prices: weight, class, and miles. Now, class involves a myriad of other things, and I know we can get into the density-based pricing argument, but that's not for today. Class is basically a measure of density and value, likelihood of liability and damages. So we need to clear out as much of that as possible to get to the true market indication of what pricing direction is doing in the LTL space. So that's what we've built here, is 20 tickers, 20 data points based on length of haul and class. We've aggregated between the lengths of haul. For those of you that have a SONAR subscription, you'll know that we have 5 lengths of haul: city, the local, 100 miles and below, short haul, 100 to 250, 250 to 450, 450 to 750, 450 to 800, then 800 plus, long haul freight. And then we have 4 class groupings based on basically what I would consider an FAK. For those of you that have shipped LTL, you'll know what an FAK is, freight all kinds, but it's basically a grouping of similar commodities or similar class freight. And it goes 50 to 65. That's your lowest end, your densest freight, the stuff that's the hardest to damage. 50 to 65, generally your industrial materials. That's going to be the stuff that a lot of carriers compete for. That's your bottom freight. It's very heavy. You'll wait out a truck before you will cube out a truck. Then you have the 70 to 85. This is where the most amount of freight moves in the LTL space. It is your retail freight. Electronics move here in general. This is the most dense band that we have. Also, anybody interested in economics, breaking stuff out by class really helps you get a feel for how the industrial space is moving versus the retail space. Anybody interested in that can get some decent indications here. Again, price direction changes are the output of supply and demand. When prices are going up, supply is below demand. When prices are going down, demand is above supply. And that's the premise here. And then the next couple of class groupings, 92.5 to 110 and 125 plus. The big nuance with 125 plus, that's your high cube freight, your foam pads and your mattresses and stuff that cubes out a truck real quick that nobody really wants to deal with unless they're throwing it on top of something. Old Dominion doesn't want to deal with this freight unless they need to throw stuff on top of a dense, palletized base. That's going to be the one that moves fastest in our data, in our studies, because that's going to be the one that carriers are basically saying we don't need it earliest, and we need it, or we can go and compete and get it fastest. So this is actually can be an early indicator for a lot of people that are just interested in transportation in general, for the market turning and whatnot. So Jeremiah, pull up the LTL 70 just to give the audience a sense of what I'm talking about with this data set here, because this is going to be your long haul class 70 to 85, just so you can see they do move differently. And we're trying to isolate. We're getting to the kernel of the price movement. As new contracts, as new rates are coming in for similar lanes, for similar class freight, the price direction shift over the last bit is what it is. Now, you see this, pull up VC RPM and compare this. Do the compare for VC RPM 1, because I think the story here is pretty clear cut. Now, put it on a dual axis for me, or actually relative axis for me, so we get percentage change, percentage movement. And you're going to be able to see the nuance in the LTL market. For those of you that were in the audience yesterday for the state of freight, the person asked me, why is LTL not moving this way, the way that I expect? Well, you're looking at the VCRPM 1. If you were watching me debate Noel just a minute ago, I was talking about average dry van contract freight, truckload pricing. That's what that yellow line is. You can see a pretty definitive up and downturn during COVID, a flattening over the last bit. Look at the LTL chart. The LTL price, and you can see there in the end of 2023, or basically the middle of 2023, this big uptick. Why would that be? Why would we have an uptick in the LTL market at the middle of 2023? There was a huge storyline in the way that Yellow, the nation's third largest carrier, exited, and you can see that the price change there, it injected enough demand into the LTL environment to put pressure on prices to push them higher. And I call that the yellow bubble, which is now popping slowly. But LTL market essentially gets a little bit of a pass here on the freight recession because Yellow exits, less fragmented, less competition, and of course, one of the nation's largest low-end providers leaving the space. And now we can see that it's starting to normalize, but it probably got a pass on some of the deepest discounts that we would have seen, even though the LTL space doesn't necessarily move 100% in alignment with the truckload environment. With that being said, feel free to come back to our booths back there, but I'm going to hand this over to Mike to talk to you guys about the intermodal contract rates.
Great. So what the intermodal contract rates that we're releasing today have in common with what Zach was just talking about is that there's really a tremendous amount of demand for them. I think whenever I talk to customers on intermodal, I go through all the intermodal data that we have, and inevitably comes down to you don't have intermodal contract rates by lane in SONAR. Well, now we do. Relieved to say that we do. We have intermodal contract rates in 67 lanes, and we're also releasing 2 indexes, a transcontinental head haul index, which is an average of 5 dense intermodal lanes that are outbound from LA to Chicago, LA to Dallas, et cetera, and also a local east index, which is the 10 dense corridors in the eastern 1/3 of the country from Chicago to points eastward. So really using kind of the language that the domestic intermodal companies use on their earnings calls. So I think it'll help the financial analysts. And I also think it'll help shippers to get a sense of what's happening in the intermodal marketplace, what's happening in those corridors, help existing intermodal shippers with their RFP process. And a lot of new intermodal shippers just get a sense for where is the market. We do hear from a lot of intermodal shippers that are new to intermodal. They're getting called up by the domestic intermodal companies and want to just have an idea of what the rates should be in those corridors.
Mike, pick your favorite index to show the people.
Sure. Well, I think my favorite index is maybe just the densest lane, which is LA to Chicago. I'm a Chicago guy, so I'm going to do IMC RPM.LAXCHI. So this is going to be your densest corridor, if you want to put that on an absolute, that shows it's up 19% versus 5 years ago. But if you want to put that on an absolute, I think it's about $1.43 a mile. We also have a ticker that shows just a number, so you don't have to do the math of multiply that by 2,200 miles. That saves you that step. So about $1.43, and so if you're looking at how much you would save versus truckload, it's pretty significant. If you want to pull up another lane, another dense corridor out of LA is LA to Dallas. Also, have strong ties to Dallas. That's where I live now. So you pull this up, and
not the Cowboys. Not a Cowboys fan.
No. They're not really in Dallas. They play in Arlington. Much different place. So this is $2.07 a mile going from LA to Dallas. And so you sort of compare those two, and truckload is more competitive in that LA to Dallas lane. It is going to be hard for truckload ordinarily to compete from LA to Chicago down at $1.43. And we can take that and really leverage some of the other data that we have on the truckload side of things. If you want to go to the market dashboard application, which is one of our most used applications, we got this from a consortium of 3PLs, and Jeremiah has in there Los Angeles to Dallas, the very same corridor, and you can see what it is on the truckload side. So on the truckload side, we're looking at I think that says spot rates of $2.63 and truckload contract rates of $2.50. And we just saw on the previous chart, or he has down at the bottom there, about 207 for intermodal contract rates. And so if you're a shipper, that's roughly what you should expect to be saving. Call that 15, 17%. And that's within the reasonable range of what you would expect using intermodal. And so what I would suggest to shippers is do this for analysis for all of your lanes and see where intermodal makes sense, where it doesn't make sense, and go from there.
Yeah, I think the use case is there for even people that don't deal with intermodal. I mean, if you're an operator or a broker out in the space, you need to know where your competition's at. You need to know what you're dealing with. Intermodal, of course, doesn't have the same flexibility. Obviously, the rails are pretty static. But these rates include fuel on the intermodal side, correct, Mike?
Yeah, so they include fuel on the intermodal side, and then these rates also include fuel on the truckload side, which is an important point. If you want to know what the real savings rate is, you need to include fuel for both modes. You're going to, it's more fuel efficient to use rail intermodal. So that's an important point. Should also mention that these are domestic intermodal rates, so something that a shipper might expect to pay to J.B. Hunt or Hub Group or Schneider. Should also mention that these are door-to-door rates, so they're going to include the drayage on either end of the intermodal move. And the underlying data, we excluded any data points where the potential dray would be longer than 100 miles. So we made sure that all of these door-to-door movements, there was a rail ramp within 100 miles, because you sort of think of the average dray, 40 to 50 miles for the range. Call it 0 to 100, roughly.
Right. So I think the point here is that you're trying to compare apples to apples. We've turned out a lot of the stuff, the noise, if you will, in the intermodal data to make it a true comparison. And of course, anybody that's interested in understanding the dynamics of the freight market right now, intermodal has become an extremely huge player, one that has, obviously helped keep some of this lid on the spot market volatility that we've seen here in the last couple of months, a lot of import volumes, import demand. So understanding the interplay between all of the surface transportation and modal conversions. Mike, you've built anybody that has APIs has access to our Excel add-in. A lot of this data, anything that is in a tickerized form can be pulled out into a spreadsheet for direct analysis and pricing modeling, et cetera. So I think that's one of the strongest use cases. Anything else to add?
Yeah, leverage the Excel add-in, for sure. I'm happy to share a decision-making tool I built in the Excel add-in, which compares intermodal to truckload in a lot of the dense corridors. A shipper can customize that, for its needs. But happy to go through all of our intermodal data. Reach out to your CS, person or SONAR representative, and we'll go through this data with you.
Well, there you have it. I always have to talk about the Excel add-in because I lived in Excel for so long, and as much as I think it's cool to look at data in here, having the flexibility of putting something in Excel as the world operates on a spreadsheet still to this day for a large part, whether that's good or bad, is always good. But please feel free to visit the booth if you want to see more about the intermodal or LTL pricing rates, and thank you.